So the business valuation group at Grossman, Yannick, and Ford, this sounds really loud, right? Is that good? We're gonna close out the day for you guys. Can't express gratitude we have for your time and attention. We will do our best to make this informative and a little bit entertaining, hopefully. I think what will be entertaining is I was just looking at my slides before this, so if I stumble a little bit, let's just laugh it off and go have wine after this. So our talk today is going to be looking at the impact of OB3, as we call it in the business valuation group, on valuation. And as we talk about valuation, it will be primarily focused on privately held businesses, which is primarily the space where we're doing all of our work. But before we dive in, this is us. And Brad, we should probably refresh our pictures. I try to do mine like every 16 years. If you look at me on LinkedIn, seriously, look at me on LinkedIn, I am 36. So I'm trying to do it, every so often. I think this is 46, so we're just going to go another decade. But I want to bring your attention to something on this slide here. As you guys know, I've been a partner in the business valuation group for a number of years now. And I have, I think, since 2011, I might cry a little bit, but I'm going to try to keep it down. I was joined by this gentleman over here to my left. 2011, right? He joined as an associate in the business valuation group, right out of college. Why? Why did he do that? Well, because Brad came out of Pitt. He had not only an accounting degree, he had a finance degree. Great, we look at both of those things in valuation. He also came with an economics degree, and in addition to that, Dave came in, put his briefcase down. Hey, Melissa, I already passed the CPA exam. I'm like, all right, he will be running the show very shortly. So shortly after Brad joined the group in 2011, he started to go after the credentials in valuation. He attained those other, we don't have our credentials after, but he obtained 2 highly coveted valuation credentials soon after joining us. In 2021, Brad was recognized by the National Association of Evaluators and Analysts as a under 40 honoree. So as you guys know, attending CP days, because there's so many familiar faces, and welcome to the new ones. But for those regular attendees, you guys know that Brad is extremely technical. He knows what he can articulate what he knows in valuation, which is sometimes very highly technical, but he can articulate that to our team, to our clients, and to all of you in the room with whom we have not worked yet. But what people don't realize, what sets Brad apart, is that he's an amazing human. And I think I can speak on behalf of everybody at GYF, both in our group and in our firm at large. He is an amazing human, which makes me excited to give him the promotion. Well, he earned the promotion. I didn't give him anything. He earned the promotion as Director in Business Valuation. So if you guys wouldn't mind, just a clap for Brad.
Thank you.
I was so nervous to get that out because I don't know, it's age, I get a little bit emotional, but we've worked so closely together. I always say he's like my younger brother. But as I was telling our colleagues, I said, he's either going to be embarrassed, like my kids would say, Mom, that was totally cringe, why'd you do that? Or I'm hoping you see this as just a way for me to publicly thank you for everything.
I feel like Taylor Swift at the Grammys.
As long as Allison doesn't come up here like Kanye. So getting back to business. So as you guys heard with the tax group with John and Ryan on theme today with their sweaters, talking about all the provisions in OB3. OB3 actually contains many aspects of it that will impact business valuation and the way we perform business valuation, because it's materially shifted several valuation drivers that we use for business valuation of privately held businesses, principally by moving some near-term after-tax cash flow, changing tax treatment of capital investment, and also giving some incentives in terms of pass-through businesses. We will start to see some changes in the way that we are doing our business valuation work. So as you'll see later in the presentation, these changes will tend to raise enterprise values of our companies for those that are mostly capital intensive, research. Brad will talk a little bit about R&E, as we used to call it R&D, and certainly companies that are pass-throughs in the near term. So we as valuators will be challenged with creating these models and helping to create these models to incorporate all of the changes that we need. I think as I alluded just a moment ago, OB3 will contain specific provisions that will impact certain industries more than others. Capital intensive industries, of course, and then research driven companies. We in fact have Brad and I were huddling today in the boardroom here over a company that we have that is very research driven, and we're looking at how we're modeling in the behavior of the economic benefits of R&E expenses. Energy sector, which I'm sure Don and Ryan talked about, will also increase as well with fossil fuel permits. So with that, let's just briefly talk about valuation fundamentals. We all know, well, we should know by years of hopefully you were listening to us, but valuation is always forward-looking. You really don't care if you own PPG stock, you really don't care what that stock did for you in the past. You really want to look forward to see how it's going to perform for you. So value is predicated on those future earnings and cash flow with associated with risk of achieving those cash flows. So the risk is going to be quantified in what we call a discount rate. It could be a weighted average cost of capital, which we'll talk about today, or simply an earnings multiple. So future earnings will consider all elements of cash inflows and outflows when you think about it. Ultimately, income is one thing. However, what we seek to do every time out is to solve for that, free cash flow. So as the business landscape shifts a bit here, we will see changes in risk. We'll also see changes in earnings, and invariably those will have, likely won't be offsetting, and will likely have an impact on value. So the degree of the impact will depend certainly on these discrete period forecasts and projections that we're going to talk to you about, as well as the associated assessment of risk. So additional fundamentals. In business valuation, operating companies, of course, we're going to look at them as a going concern. We would look at a company that is in liquidation certainly differently than we would look at a company that is a going concern. But when we say that, we have to do what's known or knowable at the date of valuation. So what does that mean? We're going to incorporate current tax, legal, other regulatory policies without consideration of some things that might change off on the horizon. So it's important to understand that when we're looking at discrete period forecasts for our clients, and mostly 36, 60 months, we're going to incorporate all of those things, including what we know through OB3, in those discrete period forecasts. So we're not going to be looking at potential changes out into the future. Valuations, as I said, will consider and reflect the new expectations in light of the current business environment, which I think Stu did a great job in talking about how things look both globally, nationally, and regionally. And we will, as our team, be looking at assumptions that are going to be driving the forecasts that we're looking at for 2025 and beyond. So forecast assumptions for us are extremely paramount with something like OB3.
All right, so just to do a quick overview again of what we are referring to as OB3, it seems like a number of people in the business valuation community have really clung to this acronym OB3. I know firm-wide we haven't necessarily set a standard for what we call it, but quick summary, I know you heard a lot today with Dawn and Ryan in their beautiful sweaters that were appropriately sized for both of them. I offered to cut Ryan out of his, but he wanted to do it the old-fashioned way. But OB3 was signed on July 4th, 2025. So when we're talking about business valuations, we're always going to be looking as of a very specific point in time. So when we are engaged to do a business valuation, part of that engagement will say, this is the effective date of analysis by which we're going to be putting an appraised value on the company. If it's before July 4th, 2025, we have to really forget about the fact that OB3 did come into place. If it's after July 4th, 2025, we get to incorporate all the nuances that we see in the legislation. Large legislation, as Dawn talked about, it's going to impact both individuals, families, but we're going to be focused here on businesses, specifically privately held businesses. It has obviously created a wide range of planning opportunities. Just to reinforce, GYF as a firm, we're trying as best as possible to stay on top of how this is going to impact all of our clients, all of our contacts from every perspective. Obviously, the tax perspective as being a tax-focused bill, but as we talk about here today, from a valuation perspective. So what are some of the key provisions? There's a number of provisions that are going to impact us on day-to-day life, but what are some of the key provisions that are directly going to impact business valuation? We're going to talk about each one of these in a little bit more detail, but from the high level, these are the 5 that we've narrowed in on as the most impactful to the valuation of a privately held business, but you're also going to see how these have impacted the public markets as well. So the corporate tax rate environment, valuation is always going to be impacted by whatever the current income tax rate environment is. So any changes or expected changes in that environment is going to have an impact on value. The bonus depreciation or Section 179 deductions both obviously relate to the ability to deduct capital expenditures and how quickly we can use those deductions to shield our taxable income. Section 174 expenditures, this is probably the one we have a numerical example about this one. This is probably the biggest one in terms of modeling how it's going to impact valuation because of, as Dawn talked about, the immediacy in which we are going to see a change in how those were recorded. And then net operating losses, obviously the ability to take losses to shield taxable income, and how quickly or delayed we are able to do those will have an impact ultimately on valuation. So starting with the corporate tax rates, so as I mentioned, the tax rate environment is always going to have an impact on valuations. So valuations are primarily concerned with the future expected cash flows of a business. That is, what is the return on investment that an investor is going to receive if they purchase a business? That's always going to consider taxes, whether the entity itself is a tax-paying entity or whether it's a flow-through. We always say that hypothetical investor realizes that Uncle Sam is going to take a cut of those proceeds before it comes to the investor. In a C Corp, it's easy because the C Corp is going to pay that tax directly. In a pass-through entity, as a shareholder of a pass-through entity, even though the corporation doesn't pay it, I do have to consider it because I do have to pay those taxes before I realize my true economic return on that investment. So because we're principally focused on that after-tax cash flow, any changes in that tax rate environment will have an inverse relationship on value. So if tax rates increase, that provides for lower expected cash flow, ultimately lower expected value of that privately held business. So we say what changed? Nothing really changed here necessarily. Really, it made permanent or reaffirmed the permanence of the 21% corporate tax rate that came into effect with the Tax Cuts and Jobs Act. So when the Tax Cuts and Jobs Act originally came into place, I know many of you will remember what happened in the public markets. So this new act comes into place, lowers the corporate tax rate to 21%. Immediately what you saw in the public markets was an increase across the board. When we are doing an appraisal of a privately held business, the same items that are going to impact the public markets are ultimately going to impact a privately held business as well. So if publicly traded companies expect to pay less taxes, that's where the market reacts and prices them accordingly. If we have a privately held business now that we expect to have a lower tax burden, same impact we would expect to see in terms of ultimately a higher value. So really, no increase in this tax rate means more reliable or less risky forecasted cash flows in the future. There are a number of valuation professionals, we didn't necessarily completely buy into this theory, but there are a number of valuation professionals that said, if you don't believe that this 21% corporate tax rate is truly permanent, then you need to account for that somewhere. So if there is real risk that that corporate tax rate may increase into the future, then you need to build that into your model, presumably in some type of perpetual tax rate that you would expect to be different than that 21%. With this OB3 restating the permanence of that 21% tax rate, now we know that that means that those cash flows are less risky, more reliable, will ultimately provide for more reliable, slightly higher values.
With respect to bonus depreciation, what has changed is 100% bonus depreciation was made permanent. So there's immediate write-off of CapEx for property placed in service, and tax people, correct me if I'm wrong, January 19th, 2025. I would say, ding, ding, ding. I would say that if I say something about tax code that is in direct contrast to what Dawn and Ryan said, defer to Dawn and Ryan. I'm trying my best here. It's intended to sunset, and the amount of the write-off would, it was intended to sunset, and the amount of the write-off would step down. But now this allows companies to immediately expense the full cost of eligible assets in year one rather than a maker's tax life. The expected impact, obviously, it's going to materially accelerate tax deductions in earlier years. So what we're going to see when we do financial modeling, you're going to see more tax deductions in the way of depreciation, which then, offers to increase the tax shield with that more immediate write-off. There's going to be a lower level then of income taxes then will result in an increase in after-tax earnings and an increase certainly in near-term free cash flow. And therefore, as we look at a discounted cash flow model, it will have a bigger impact as you present value those cash flows back to the date of valuation. So a shift in timing of deductions changes certainly the timing of the tax benefit rather than the total economic cost. So what we're seeing here with the bonus depreciation made permanent, just a bigger benefit at the beginning when we're looking at forecasts, if that makes sense. OB3 also increases and clarifies Section 179 expensing limits, which together with the revived 100% bonus creates an even larger immediate expensing opportunities. So as you can see here, what changed from 179 is the limits increased from 1 million to 2.5 million with broader applicability as that is defined and described in OB3. The expected impact, again, of this is that additional tax shield that's created with these capital expenditures. When that happens, you have a decrease in the tax liability all things being equal, you should be seeing generally a higher value. OB3's expansions make more building-related components eligible for first-year depreciation deductions. So therefore, there is going to be a definite impact in real estate and investments. So when valuing businesses post OB3, we treat the enhanced Section 179 and bonus depreciation as a forecastable cash tax driver. But it's not, we're not creating free value, if that makes sense.
All right, so shifting to Section 174 expenditures. When Don came up here earlier, he had a numerical example on this, and we're going to have one as well. Just looking at it from a slightly different perspective. But as you'll recall, these expenditures that fell under 174, previously, before OB3, had to be capitalized and then deducted over time. So what that created was just a timing difference between true money out the door and then your ability to deduct those for tax purposes. It accelerated that recognition of taxable income, really led to higher taxes in the short term. So now what has changed? It repeals that rule that we no longer need to capitalize these expenditures, and we can take those capitalized expenditures and accelerate their deduction either immediately or over a couple-year period, as Don showed us in his numerical example. So the ability to immediately deduct that, or the acceleration of that deduction, is going to provide us a very short-term tax shield. So for valuation purposes, when we're valuing it as of a point in time, what that creates is a accelerated return on investment for that hypothetical buyer. So I seem to routinely find myself in a room full of accountants, and when I do that, I like to put numbers in front of them, right? As an aside, so this morning, my 3-year-old woke up early before I left. I let him pick out my tie this morning. He has never seen a tie before because it's very rare that we have to do that. So he said, "Daddy, what are you doing at work today?" And I said, "I'm going to go sit in front of a room full of accountants and talk to them." And I think he's going to still want to be a race car driver when he gets older. So. What you see here is just an example where we are looking at capitalizing expenditures over a 3-year period. Year 1, $200,000, year 2, $250,000, year 3, $300,000. So as we sit here after year 3, what we see is $750,000 of cash out the door, and you can see how prior to OB3 that had to be amortized. So that deductibility really has a tail that delayed the ability to write it off for tax purposes. So when we're trying to look at this from a valuation perspective, remember, we're looking at it as of a specific point in time. So if we're valuing a business, or if a business is looking to enter into a sale transaction, we're trying to understand, as of that specific point in time, how is this going to impact the value of the business. So as we sit here after year 3, we already have $750,000 that was spent. That money is out the door. But we were only able to utilize $280,000 of that to shield against taxes. So we have roughly a third of our true cash out the door we're able to use to not have to pay taxes. Now we have $470,000 that we can use as a tax shield and produce increased income either immediately or over a 2-year period. We're going to assume immediately. So for business valuation purposes, where we are making an assumption that that hypothetical buyer steps into the shoes of the current owner of the business, what that creates is an ultimate increase in value because of that increase in short-term cash flow associated with not having to pay those taxes immediately. In a real-world transaction, if you're working with a company or if your company is looking into entering a transaction, it's really just something that needs to be negotiated and considered to make sure that the value of this tax shield, the value of these capitalized expenditures, is properly treated, and that either you or your client gets the highest benefit for the fact that taxes have already been paid on that amount of money. The last item that we'll hit in terms of pieces that impact valuation, so net operating losses. So NOLs now must be carried forward indefinitely. The impact here, so if the carry forward would have ended, it would have allowed companies to use future NOLs more quickly. But now we still have to carry them forward, so what does that do? That reduces the benefit of the generation of those NOLs as a tax strategy to net against future taxable income. What OB3 did allow for is any NOLs that were generated in the years 2022, 2023, and 2024 can be retroactively applied. So companies with NOLs from those 3 years that were required to carry those forward now can immediately use those to offset taxable income. So the ability of an acquirer in a business to utilize those NOLs really needs to be critically examined in any type of stock transaction. So if you have if you're working with a business, if you're part of a business that's entering into a sale transaction, and either they had NOLs generated in 22, 23, or 24, or they expect to generate NOLs in the short term, those truly need to be modeled and considered in terms of what will that mean for future tax liability and how that can be shared with the buyer, if that can be shared with the buyer, and who really needs to be the beneficiary of those NOLs.
So let's, Brad and I are going to tackle separately the main methodologies or approaches that we use when valuing businesses. If it's an operating business, first and foremost, we're going to be looking at an income approach. As we talked about fundamentals, what's the free cash flow, what's the risk? Very simplistic way to look at it. Market approach, Brad will talk about how we look at multiples currently and certainly into the future. With respect to the income approach, going back to that fundamental precept of valuation is that value is always forward-looking. So it's going to be based on those future economic benefits. Future economic benefits, as we've noted, that we look at is going to be free after-tax cash flow. Going back to one interesting point I wanted to bring up, I would say it's started in 1990, may have been the first case. There was a case that came through in tax court that it was the Gross decision, Gross, and it talked about, hey, valuators are using corporate tax rates. However, pass-through tax, an S-corp is a pass-through and therefore does not pay corporate-level taxes. So over the years, there were a couple of bad facts cases, but as it came about, precisely what Brad said before, it's, well, if you're an owner in a pass-through, an S-corporation, LLC, something like that, someone's paying the taxes. So that point finally got through to the tax court in other cases that they looked at it, and I think the case that broke through was in the Delaware Chancery. But so now we talked about, well, yes, somebody's going to pay tax. So we looked at, well, what's the individual tax rate versus what federal tax rates are? And for a very long time, I didn't care because they were very much equivalent, right? You were paying almost a 40% corporate tax rate if you're in Pennsylvania, which is now changing, as we know. And but you were paying individual tax rates that were approximate to that, not too much of a delta. Well, here, one of the things that we're seeing with the 21% made permanent, I do think that there's going to be a revived discussion on, well, Melissa, you said they were equivalent before, but now corporate tax rates are actually considerably less than their individuals that are taxed on a personal level. So kind of don't mean to get very theoretical, but I wouldn't be surprised if with this being made permanent, some more discussions in terms of, okay, how does that look when valuation professionals, we do still use corporate tax rates because the discount rates that we use are based on corporate tax yields. So we are matching. As far as we know, in the valuation community, there's no adjustments to bring those two tax liabilities in alignment. So as we look at the future, it's going to be predicated on a set of forecasts that have reasoned assumptions. And a lot of those assumptions are going to be, and I think it's on my next slide, but a lot of those assumptions now are going to be driven by OB3. I think, and why I wrote this bullet point, is that management teams of most companies, privately held companies, will revisit their business plans to take advantage of the provisions of OB3. So when you think about the acceleration of depreciation, when you're looking at a capital spend, what does that do? With the release of some additional free cash flow, your payback period on if you're taking out a loan, your payback period is reduced. So, I do think that looking at reforecasting cash flows, I do think, and I've talked to people today, that management will be looking at separate schedules in forecasts regarding tax timing and permanent changes, which I think is probably a wise thing to do. The other thing that Brad and I were talking about today is we have a client that is making substantial investments in R&E over a contracted period of time. They are going to take advantage of the tax cuts for that. But one thing Brad and I were talking about is we're investing now. When, at one point, do we map in the benefits from that R&E, right? So we need to maybe thinking a little bit beyond that 5 years. Maybe we have, because typically in a discounted cash flow model, you'll have a discrete period, and then you'll have a terminal year. Well, maybe the timing of the terminal year isn't right because we might be missing some years of heightened intervening growth. So I do think that management, CFOs of a lot of our clients are going to be taking a look at business plans to take advantage. And as we talked, I think I belabor this a lot, but many provisions are going to increase cash flow and providing more flexibility to the company. And as I said, accelerating payback periods and capital projects. Also, it changes, I feel like it changes deal economics for acquisitions and certainly development projects. Oops. Did you advance my slide? Oh, I'm sorry. So some of the things that we're going to see in cash flow, certainly 21% federal tax has become permanent. We see a reduction over time in the Pennsylvania tax if our clients are mostly in Pennsylvania. And then that tax will stay steady. Is that 2026? I want to say 2026. So we'll see adjustments in tax rate. Obviously, we'll see tax liability reduced by all of the aspects of OB3 that provide this tax shield that we talk about. We will see changes in the way that capital investment's made. Some things might be front-loaded, but understanding as we look at cash flow, certainly, yes, that's a use of cash. Working capital. Another thing that we're challenging our clients to look at is how does your working capital investment change after OB3? If you plan to experience growth, maybe you went ahead and bought that lathe, maybe you went ahead and bought some additional equipment or investment in AI. How does that change your working capital in the future? Because value is forward-looking, so maybe your working capital requirements in the past aren't reflective of the way that they're going to be in the future. And as I said on the earlier slide, we're going to be looking at and with a fine-tooth comb, the terminal value, because in a discounted cash flow model, on average, the terminal value is about 70% of the overall value when you apply that terminal value model. So one of the things that we're going to be looking at is in a terminal value, we're not going to be treating one-time changes as being permanent. So I think we'll see greater emphasis on what we consider that terminal value. And I think another thing that Brad and I were talking about today for a client is, well, if we're not confident to map out another 3 years of this discrete period forecast, we're probably going to put together what we call an H model to recognize what that heightened growth rate is going to be in cash flow for the next few years, and then hit it at the terminal value. And sorry to get a little bit technical with you on that. So when we look at the other side of the equation, so we talked a lot about cash flow and how in the near term that cash flow is going to be freed up and likely have a bigger impact on value when you look at that in present value terms. The other side of the equation is the cost of capital, that discount rate. We will be rethinking our inputs to that as well as we develop these discount rates via interest rates and risk premiums. So we will see a lower tax yield on debt. We will factor that in, lower expectations in terms of tax we will also consider. And then when we look to the weighted average cost of capital, the cost of equity, we will be reassessing risk premiums, especially company-specific risk, as if investments are being made, creating more stability or capacity and increased cash flow of the company, perceived risk may be declining. Industry capital structures may change as a result of OB3. When you look at more debt, if a company accords more to debt in their capital structure, debt actually costs less than, debt costs less than equity. As such, your weighted average cost of capital is going to go down, and then value goes up. So ultimately, I think, as a practice, we're going to need to separate some tax timing from sustainable economics and recompute long-run effective tax rates. And I know you guys are probably cringing, but I do think that those things are coming as we look at the future weighted average cost of capital discount rates.
So taking a look at the second of our three approaches to valuing a business, the market approach, and how has OB3 impacted the market approach? When I'm sure a number of people that have been here for a couple of years, you've heard us talk about the various ways to value business. The market approach I most routinely relate to how you get your house appraised. So when my wife and I bought our first house, it was a townhouse in a townhouse community. We always knew what it was worth because we'd have a townhouse sell across the street. Whatever it sold for, maybe make some adjustments because they didn't make some updates or we didn't make some updates, but you have a pretty good idea of what your asset is worth based on transactions of related assets. The same can be applied to valuing a privately held business. If I own a pizza shop and there's a competitor pizza shop that's sold in the last couple of years, we are about the same size, you can use that as a reasonable estimate for what you think that your pizza shop may be worth in kind of the simplest terms. So under the market approach, there are two specific ways that we could quantify the value of the business. The first being the guideline publicly traded company method. So here, we're going to go look at public companies and try to determine, are there any public companies out there that are sufficiently similar to the company that we are trying to appraise? If so, we can take those trading prices for that public company or group of public companies, convert that to a multiple, an enterprise value multiple of EBITDA, and apply that multiple to our company. The nice part about using the guideline publicly traded company method is, going back to economics 101, the efficient market hypothesis basically says that those trading prices of companies constantly take into consideration all of the available information at any point in time. So when you have a new tax law that goes into effect, you're going to see movement in the trading prices of these public companies that is going to incorporate the expected impacts of those tax law changes. So if we are going to take a look at using publicly traded companies to appraise a business, those trading prices after OB3 has been put into place are incorporating the impact, the positive, generally, impact of the tax attributes within that act into the multiple itself. We can then use that multiple and apply it to our company's metrics. Alternatively, the guideline completed transaction method or the guideline merged and acquired company method looks at sales of privately held businesses. So obviously, unlike publicly traded companies, that information isn't readily available, so there's a number of different databases that we subscribe to where basically brokers generally are the ones that report transactions and deal structures and deal terms to these databases so that they can accumulate all of that information and provide similar type information, multiples, trading prices, dates, size of the target company, so that you can go in and look, hey, is there a population of privately held companies that have been sold that are similar enough to the company that we are trying to appraise, that we can use those metrics and apply them to our subject company to provide an indication of value. So one of the big issues that we deal with in this method is that value, that company that was sold, that privately held company that was sold, that was as of a very specific point in time. So these databases go back years. So if we have a transaction that occurred in some type of different either tax regime or required some type of adjustment, just like when my wife and I would tour a townhouse across the street that had a renovated master bathroom, we had to make an adjustment in our heads as to what would that sale price be for our townhouse. If we have a company that's sold under a different tax regime or doesn't have the same benefits that we would see as a result of a new tax law, we may need to adjust the multiples accordingly to make sure that that multiple is applicable to the company as we sit here today. So multiples do require that adjustment for any number of reasons. What OB3 is really going to provide is that it's going to require consideration on the valuation perspective to adjust multiples for any situations where those transactions may have occurred in some type of regime that would have been impacted by OB3. So if a transaction happened and now that OB3 is in place, the buyer in that transaction would have incorporated these new laws into the pricing of that company, that multiple now needs to be adjusted to truly reflect the value of the company after putting in OB3. Just some other kind of high-level things to consider with the market approach. So we're going to see potential shifts in multiples as a result of needing to incorporate the new items within OB3. An example that we think we will see pretty shortly here is manufacturing companies. Obviously the 100% bonus manufacturing investment credit. We would expect that because we have these business-friendly provisions included in OB3, that it's going to have a positive impact on the trading multiples in those industries. And you will likely see that fairly shortly because of how quickly companies can use some of these accelerated depreciation methods to be able to shield themselves from taxable income. Don mentioned the reinstatement of the EBITDA-based business interest expense limitation. Really what that does is, in terms of deal structure, it makes leveraged buyouts more feasible. So a more desirable deal structure should provide for buyers willing to increase those valuation multiples whenever they're pricing companies. And then last year, Don mentioned the Section 1202 qualified small business stock. A few changes here: shorten the holding period that owners of this stock must hold it in order to receive the favorable tax treatment. It also increased the cap in which you could recognize a gain and not have to pay tax on that gain. So for these situations, we would likely see that, again, multiples are going to be positively impacted because of the tax favorable provisions of OB3. And then finally, the last section that we want to hit here is, how is OB3 going to impact your business, or, different things that you or your company or your clients may be seeing here in the short term, or at least ones that we know that we expect to see. So in the estate and gift tax planning realm, as we noted earlier, the lifetime exemption, which was scheduled to revert or reduce to the pre-Tax Cut and Jobs Act levels, will not revert to those levels. It'll continue to grow. It'll continue to be indexed for inflation. So this is obviously good news for taxpayers, right? We still have this pretty high limit when you consider where it's been historically. Really what it provides for in estate planning is more flexibility for taxpayers, for owners of these businesses. It will provide for increased scrutiny on the valuations of these business interests. Anytime you have changes in these types of rules, the user of the report, and in this instance it's going to be the IRS, is going to make sure that any report that comes across their desk is fully considering all the new impacts, all the full nuances. So the valuators, the onus is on the valuator to make sure that they're fully considering all of those impacts. Value assumptions should be reassessed in all of our valuation models, obviously a number of the ones that we talked about here today. We would argue that a taxpayer doesn't need to be as aggressive, right? When we have this higher threshold, more aggressive valuation, whether that be in the assumptions for valuing the business or any discounts that are taken, with the exemption where it is today, provides for the ability to be less aggressive from a taxpayer standpoint in providing the value of a gift. And then actually the middle point here, it's not necessarily specific to OB3. It really is something that we always encourage clients, contacts to do on a regular basis. Buy-sell agreements or provisions within shareholder agreements or operating agreements that relate to buy-sell provisions should be revisited. It's always a good opportunity for us to say, go pull out those documents. I'm sure a lot of you have seen this. Shareholders of a company, members of a company, sign these documents, put them in a drawer, and don't look at them for decades. Well, as we get changes in the landscape on a tax basis or operating basis, you need to make sure that anything that is in those legal documents, which is now set in stone, needs to be readdressed, because if it doesn't currently line up with what the owners of the company would want if any of those provisions were triggered, those need to be amended to make sure that they do consider anything new to be incorporated there. Mergers and acquisitions, the primary impact on transactions is really the importance of deal structure in conjunction with these, again, primarily tax provisions, and making sure that you or your client or your company gets the maximum benefit, whether they are on the buy side of a transaction or the sell side of a transaction. Obviously, deal structure has to consider these new rules, and especially if, as we mentioned, the company has unused NOLs in 22, 23, 24, or is expected to generate NOLs here in the future NOLs in the short term. If a target company does have those NOLs, or if a target company is expecting NOLs, it's something that really needs to be understood, and then in that negotiation process needs to flush out who really should be the beneficiary of any of these NOLs that is going to be able to pretty quickly shield from taxable income, and how does that need to be incorporated into the negotiations of the final transaction price.
So if you don't look at your buy-sell agreement or your shareholder agreement, or your deal has gone bad, you're going to end up on our litigation side of the practice. Potential litigation with disagreements over valuation, especially if you're looking back to a controlling document that's a shareholder agreement or a buy-sell agreement that doesn't really speak to you how you determine value. When you get to a court scenario, I will say in a lot of jurisdictions in which we work, they don't really like forecasts. Believe it or not, even though the basic precept of valuation is it's always forward-looking, courts really like looking back as to what's happened in the past. So we might see an uptick in shareholder disputes, but I do think that there will be certainly challenges to explain, if you're on the stand, explain, or if you're being deposed, explain the models that you're doing and the underlying assumptions. So that's always a challenge, but expert testimony certainly should be updated to consider these methodologies. In the 17 seconds I have left, I'm going to go to the end and say just key considerations. We know that TCJA provisions are now permanent. We're going to be revisiting our valuation models, and certainly I think all businesses should gain an understanding of how OB3 will impact their business. But I will say for a lot of sectors and privately held companies, there might be some meaningful improvement in the value of the business as a result of increased cash flow. Thank you so much for your time, and attention. Here's our contact info. Should you guys have any question or have a need for support,